Hi CA students, let's quickly revise Ind AS 16 property, plant and equipment. So PPE is nothing but a tangible asset. So asset means we should have control over the asset, and then it is held for use for either goods or services or for administrative purpose or rentals to others, and it should be held for more than 12 months. The recognition criteria should be future economic benefits that should flow into the enterprise and cost measured reliably. And the exceptions are for this standard is 105, which is non-current asset held for sale under discontinued operations, and any lease assets and biological assets other than bearer plants. That also is an exception. Then spare parts, standby equipment and servicing equipment. If recognition criteria met, then PPE. Otherwise, it will be inventory only. Recognition criteria is that web and cost measurement. Day-to-day servicing is P&L, transfer to P&L. Day-to-day servicing is all those repairs and maintenance. And then replacement parts, major inspection and overhauls. If it is new, then if recognition criteria meets, then can be capitalized as PPE. Otherwise, expense off to P&L. If it is old, the old portion has to be de-recognized. Component accounting has to be followed. Then at the initial measurement of PPE, purchase cost will be cost plus the direct attributable cost towards that PPE. Then any dismantling or decommissioning charges or site restoration cost is involved. That has to be discounted to the present value and added to the cost. This will be the PPE value at the initial recognition. Purchase cost includes taxes, import duties, and which are non-refundable, and trade discounts and rebates can be reduced. And the direct attributable cost is incurred to make the PPE management ready. And dismantling or decommissioning or site restoration cost is incurred at the end of the PPE life, which will be recorded at the present value terms. And whatever difference is coming between the value, the cost as on today and then the present value, that should be recognized as finance charges transferred to PL. This directly attributable cost includes this direct labor employment benefits cost, which is the labor charge for the installation and those things. Cost of site preparation, initial delivery and handling cost, installation and assembly cost, professional fees if any for that cost acquiring. Then cost of testing can be added as directly attributable cost. In case of cost of testing, after testing, if any products we sold, the tested outcome, then that should be deducted from the direct attributable cost. It should not be expensed off, or it should not be recognized in PL as income. It has to be reduced from directly attributable cost. Then incidental operations, whatever happened, it will be transferred to P&L only after the recognition. And when will capitalization stop? Once it is management ready to use condition. Once the VP reaches the management ready to use condition, then it can be the capitalization can be stopped. After that, whatever cost is incurring will go to P&L. And how we are saying management ready, it is nothing but the location and condition necessary and capable of operating as intended by the management. That is what is management ready. Deferred payment terms, if the PPE is bought on credit terms, then PPE will be valued at cash price equivalent and not at the cost. The difference whatever is between the cash price equivalent and the cost will be transferred to PL as finance charges. The example will be in normal credit, if we are paying 1 lakh, but we got a credit terms like we can pay after 3 years but at 1.3, so the rest 30,000 will be finance charge, which has to be transferred to P&L. Now if PPE is acquired on exchange terms instead of cash, then it has to be recorded at fair value of the asset given up. That is the general practice followed. And this fair value, it has to be recorded at fair value unless two conditions. So unless means if this condition satisfied, then it can be measured at cost or the book value of the asset. So what are the conditions? Lacks commercial substance. If the transaction, the exchange lacks commercial substance, So commercial substance means future cash flow of the asset does not change, and then company financial position does not change in these two conditions. One best example will be two companies exchanging their truck with the same specification, same life, and for the same amount. Then that lacks commercial substance. In that case, it can be measured at cost only. The fair value of the asset need not be calculated because it will unnecessarily inflate the balance sheet. Then fair value cannot be measured reliably. In the second condition also, it can be measured at cost. When can fair value not be measured reliably? In some situations where the machinery, the production factory machinery will be custom made for specifically for that business type. In those cases and all, we will not be able to measure the fair value. Hence cost can be, or the book value can be treated as the cost of the PPE. Then subsequent measurement. In case of subsequent measurement, there are two models followed: cost model and revaluation model. So cost is nothing but whatever we the acquisition cost, and then plus the DAT, and then plus the DSR will be the cost. In case of revaluation model, at every point of time it will be revalued to the fair value. So the when it will be revalued, if the changes in fair value is volatile, then annual revaluation has to be done. Every year it has to be revalued. If it is not so volatile, then 3 to 5 years can be kept as a margin, and then after every 3 years or every 5 years can be revalued. Then if we are doing revaluation, then the entire class has to be revalued. Entire class signifies the land and building is a class, machinery is a class, furniture and fitting is a class, computers is a class. Okay, then next, revaluation gain or loss. Initially in year one, if revaluation gain occurs, it is the first time revaluation gain, then it has to go to revaluation surplus, which is OCI item. OCI is other comprehensive income. And then if the first time revaluation loss is occurring, then it has to be transferred to P&L. Then what if subsequently there is a change? So I've given 4 scenarios here. The first scenario is gain in the first year and loss in the second year, and in the second scenario, loss in the first year and gain in the second year, and in third scenario, both years gain. Fourth scenario is both years loss. We'll see the first scenario. If the carrying value is 1 lakh and revalued amount is 1,20,000, so the gain is 20,000. Treatment is, it will go to revaluation surplus. Now then depreciation, I've kept 10% as an example. So 12,000 if we depreciate, then the carrying value will become 1,08,000. Now the revalued amount becomes 1 lakh. So previously first year we got a gain of 20,000. Now there is a loss of 8,000. Since we have a balance of 20,000 in the revaluation OCI surplus, that has to be reduced first to the extent of 8,000. So the treatment will be adjust the loss against the revaluation surplus. So we have to first see first year what has happened, then only we can decide the treatment in the second year. Same way, now going to the second scenario, carrying value same 1 lakh, revalued amount is 80,000. So there is a loss in the first year 20,000, which will go to P&L. Now in the then depreciation 8,000 on the revalued amount, then the carrying value becomes 72,000. Now revalued amount is 90,000. There is a gain. In the previous year there is a loss, now there is a gain 18,000. So we should not move it to revaluation surplus. We already have a loss, so first we have to adjust this to that extent of loss. So reverse loss to that extent of 18,000 in P&L. Now we might get a doubt, there is still balance of 2,000 loss. So what if next year there is a gain or loss? In the next year if there is a gain, then to the extent of 2,000 we can adjust, and then the rest will go to revaluation surplus if there is a gain. If there is loss, this 2,000 and plus the extra loss. Okay, in case of third scenario, the first carrying amount is 1 lakh and the revalued amount is 1,30,000. So there is a gain of 30,000, it will go to revaluation surplus, and then in the second year again there is a gain of 8,000. So again that 8,000 also will go to revaluation surplus. In the fourth scenario, both year losses, all loss will go to P&L only. There is no change. Okay, then depreciation will always be positive. It will not be a negative amount, and it has limited useful life, and systematic allocation will be happening over useful life. That is what is depreciation, and it will be always charged to P&L, and component accounting will be followed. And land and building. If there is a two assets, one is a depreciable asset and another is a non-depreciable asset, what will be the treatment? First we have to see whether it is separable or not separable. If it is separable, let's say in our case land, which is a non-depreciable amount, depreciation will be zero only, and building depreciation as usual. Once the amount is split, let's say we have an example of 10 lakh, land value is 2 lakhs and building value is 8 lakh, so 2 lakh will not charge any depreciation. For the rest of 8 lakh will be charging depreciation based on SLM and WV on the case to case scenario. Now the second one is, if it is not separable, what will happen if we don't know the value of land and we don't know the value of building separately, but we know on an overall basis. So the entire amount has to be considered as building and charge depreciation on the entire amount of land and building. But before doing so, we have to appoint a professional valuer to determine the value separately. This is what ICAI has given us a guidance. But for our exam purpose, if let's say the question says that the land and building is not separable, or the non-depreciable asset and the depreciable asset is not separable, then we have to the total amount has to be considered as a depreciable asset and then charge depreciation on the entire amount. The next point is residual value. If residual value is greater than carrying amount, then we have to stop depreciation. That is one point. And if residual value reassessment happens, then the same has to be accounted as accounting estimate change as per Ind AS 8. Then when should we start depreciation? Once the asset is ready to use or available for use, then we have to start depreciation. Put to use is only for income tax purpose, not for financial reporting. So this ready to use has to be taken. And when should we stop depreciation? Once the asset is de-recognized, then we can and students, we have to mainly see, we should not use anywhere in the exam paper that it is a fixed asset, because that fixed asset is as per accounting standards, and even there also it is changed. It is properly plant and equipment only. We should not use fixed asset in any of the places. Because that I have seen in one of the examiner comment of the last attempt, November 2024. So many students has used fixed asset in their exam paper, which is wrong. We have to use property, plant and equipment, PPE. Okay, when the derecognition of PPE happens, then we have to stop depreciation. Or if the asset is treated as HFS, nothing but held for sale, then in that case also will be stop depreciation. So if this either of the scenario happens at the earliest, then we'll be stopping the depreciation. Then method of depreciation, Ind AS 16 doesn't clearly says about any method, but it says pattern of economic value. On that pattern we can depreciate, and changes in method, if any, has to be treated as per Ind AS 8 accounting estimate change. Okay, when will the asset get de-recognized? So on disposal of PPE, or when there is no future economic benefits are flowing into the enterprise. In that case also we will be de-recognizing the PPE. So there will some gain or loss occur on the disposal, so that has to be transferred to P&L under the other income or other expense based on the gain or loss. And changes in model, let's say if from cost to revaluation or from revaluation to cost, there is a change in model, then it is considered as an accounting policy change, and retrospective effect has to be given from the initial recognition of the PPE till the date. It has to be retrospectively changed. And okay, impairment has to be accounted as per that Ind AS 36. So it has to be accounted separately. If the basic crux is, if carrying amount has exceeded the recoverable amount, let's say my book value of the carrying amount of PPE in my books is 10 lakh, but the recoverable amount itself is 8 lakh. So in that case I have to restate my carrying amount. So how will I do that? The 2 lakh loss has to be recognized as impairment loss in P&L. Then the asset value will reduce to 8 lakh. Then after impairment, revised depreciation has to be calculated. Then regular impairment review is necessary even if there is no sale or disposal. Okay, there is another concept called compensation from third parties. Let's say at the time of disposal, let's say if some fire happened or some theft or loss, or because of impairment, or if any damage happened to the PPE, then we might claim some insurance claims. So those type of compensation on these claims from third parties will be recognized in P&L when it is receivable. So when it is receivable, it will be recognized in P&L. We should not adjust with the loss on the PPE or something like that. It has to be accounted separately. That's it. Thank you.